But
Right.
one of the first questions I get, right, is so someone is out there, they are, I guess, let's say they're a school teacher or middle class America. They have some type of profession or whatever. They just got a nice job, nice promotion, whatever the case may be, and
Right.
they decided to get into stocks and investing and whatnot or whatever. Some of them maybe get into day trading or whatnot, and they start to make some money. And
Hmm.
some people ask the question of, if I make some money, like how does that reflect with my stocks? Like how does that play in ties when I go to file my taxes?
Absolutely. Those are all good questions and questions that I love to answer. First of all, it starts with the tax planning. And if you are going to get into stocks and bonds and any type of investing, you do want to sit down with a financial advisor and see how things will change strategically if you were to come up on your investment. And what do I mean by come up on your investment? You have
Mhm.
dividends, you have capital gains, you have things like that. You definitely want to plan for them because if you have dividends, you will be taxed on those dividends in the year in which you earn them. So that is considered income. That will change that tax return. If you're already a six-figure wage earner and then you have all these dividends, capital gains, etc., from investing, then you will pay taxes on them in the year in which you earn the dividends. So it's simple, but it's something that if you're going to take that venture and dive into investing, then not only learn how to invest, but learn the backside of it of what's going to happen when, not if you guys, but what's going to happen when my investments start to grow, when my investments start to, when they grow, what's
Okay.
going to happen.
Now, let's say if I purchase a stock, let's say if I purchase stock in Nike or whatever the case may be, and it grew, but I didn't sell it, I just kept it. Would that affect since I didn't sell it, it's just, hey, it's just sitting in my account. I purchased it and it's growing up in value, but I haven't sold it. Would it affect me then?
Only time it's going to affect you, Prince, and to all of our listeners out there, once again, if the dividends are declared or if the dividends are issued to you, if they pay them to you, then of course, then you're paying taxes on them. Otherwise, you can just roll it over and roll it over and roll it over. But the moment that they disperse or distribute any additional funds to you, it's at that point then you become responsible for paying taxes on that extra dividend, the earnings basically. And we
Okay.
have short term, we have long term. So, depending on, and let me define that. Short term is anything 12 months or less. Anything under 12 months is considered short term. Anything over 12 months in one day is considered long term. So then you have to divide your investments into short term investment and long term investment. And you're paying different taxes on them as well.
So let me guess, would the short term be higher tax or the long term be higher tax?
Actually, Prince, to be honest with you, it's the short term in which you're paying higher taxes on.
I knew it. I knew it. Uncle Sam's gonna get his piece, especially.
You know,
So,
and if you think about it,
mhm,
you think about it because when we're investing, we're taking a risk. We're taking our disposable income and we're putting it into a field or something to invest more money. Hypothetically speaking, say you get into a situation and you need to pull your money out. The purpose of investing is long term so that you see the compound interest, you see it grow. But something happens and you go and you pull it out, boom, you're going to get taxed on it.
okay.
So,
So you guys understand what you just said. You just said, hey, if you buy a particular stock and you hold on to it, and you're good to go. But at the moment you sell it and you take money on and you make a gain, if you make a gain, then yes, you're gonna have to pay tax on the year that it was dispersed to you. But if you like, for you guys out there that understood with dividends, the dividends have two ways they can be paid to you. They can be paid to you directly, and when they are paid to you directly, you're going to pay tax that year. But if they are reinvested, they'll just keep going on and on and on until that day you do decide to sell. When you do decide to sell that year, if you made a gain, you made a what you call it. You have to pay tax. Now, another question. Now, say if I got into the stock market and I'm crazy about it, and I make a lot of hasty moves and bad moves, and I lose on my investments, and I take a big loss. Say if I lose a couple $1,000. Now, how does that affect me on the tax end? Can I claim that loss, or how does that work?
Yes, absolutely. And that's a great thing too, because if you invest, you most definitely can write off the loss. And what Prince is just saying, 9 times out of 10, if you toss your money in there and then you go to sell, so you buy at $1,000, but you sell at 500, that's a loss right there of $500. So you can write off the loss as well. And for those of you who may be figuring which schedule to use. You're going to use Schedule D in the event that you are doing your own return rather than hiring a professional. You're going to use Schedule D to record those types of transactions, and that form will roll up into your loan form, Schedule 1040. But yes, most definitely. And if you have a combination of losses and gains, then of course, whatever the bottom line is, whatever the net is, whether it's a net profit or a net loss, you're still eligible to write it off. Most definitely. Yes.
Okay,
Good question.
got it. And then she just said exactly that. She said, whatever you're netting. So don't go in if you purchase something and then sell it and say, oh, look, I made $500. So now I made $500. I'm going to have to pay tax on this tomorrow. But no, let's say throughout that year, you make some other trades and you lose $1,000. So you have netted a negative $1,000. You have netted a loss of $500. Am I correct on that, Dr. White?
That is that's correct. And speaking of that, one thing I want you all to remember, because I see it a lot of times, make sure don't be so quick to have those taxes filed. Make sure you wait until you get Form 1099 DIB,
Mhm.
1099B. Make sure that you wait to get those things, especially if you are investing. Wait a
Mhm.
little longer, because there are times when the mutual funds or the investments, the corporations, they're late in sending out
Mhm.
the tax form. So don't rush, because what's going to happen is you will leave that information out on your tax return, submit your tax return, and then you will need to do an amended tax return, because if not, come the summer when the IRS decides to do an audit on various tax returns, you'll get a letter stating that our records indicate that you reported this. However, we have that, and maybe you've left off a 1099 DIB. Okay, so don't rush to file that return. Just think about, did I do any investments? And a lot of times, what I see is people will invest in stuff like Acorn or something different, small, and they do it just a short period of time, and then when tax season comes around, they forgot that they even did it, and then they get
Mhm.
that statement. Okay.
Okay. Now another question here. Um, so everybody that has a question of, hey, so where do I get this form from? Your broker usually will send out your form. So if you're using a TD Ameritrade, a Scott Trade, or a E Trade, or whatever type of trade, or any online broker where you brought your stock from, usually around February, March, they will mail you out your 1099. So she's saying,
Right.
hey, don't just try to do your taxes in December and January. Wait till February to get your actual 1099 that should come in the mail from your broker. If you don't get it, you should be calling. So
Right.
that's if you've been trading and made some gains or some losses or whatnot to reflect that. Now I had another question, right? Somebody's tuning in or they tuned in. They said, man, you know what? I didn't know that I had to file that. I didn't
Hmm.
file that last year, and I made a profit of $5,000 last year, and I didn't file that because I didn't know I had to, or I filed too fast. And now it's a new year. What do I do? What do you say to that
That's a
person?
really That's a good question, and that goes back to what I just said a few seconds ago. If you determine that you omitted something and you left something out of your tax return, I guarantee you, I
Mhm.
guarantee you, if you don't report it, then the IRS will send you a letter. Like I said, we file, most returns are due, or returns are due, most returns are due April 15th unless you file an extension. By the time the summer hits, August, July, September, you will get that notice. So it's best to go ahead and do an amended return. If you owe the IRS any money, just go ahead and send the money in or set up some type of payment arrangements so that you've admitted, I made this mistake, I omitted this, I need to report it, I'm reporting it, I omitted the return. No matter what, you're still going to get penalized and you're still going to accrue some interest if it ends up where you owe the Internal Revenue Service as a result of going back and amending the return.